Good afternoon, this is Rupert Thompson, Chief Investment Officer at Kingswood Group. It's the 1st of February and I'm now going to run through key developments in the markets last week and our thoughts going forward. Well, last week global equities were down some 3.5–4%. This actually left them now down slightly year to date, though it has to be said they've recovered about a 1% or so today. And last week, to be honest, it was a very busy week for financial news. But as far as the press was concerned, it's very much dominated by just two stories, and that is the vaccine row in Europe and also GameStop. Well, the EU Commission's desperate and ultimately ill-fated attempt to address the vaccine shortfall in Europe was a reason for this story grabbing the headlines. For financial markets, however, it really served to highlight how the recovery in Europe is likely to lag that in the US and the UK as a result of this vaccine delay. It also succeeded in drowning out the positive news. We had that two more vaccines, Novavax and Janssen, are also effective, and one of these actually only requires a single jab. Well, moving on to GameStop, for those of you who don't yet know, this is a small, troubled US games retailer. This was very much the epicenter of the short squeeze, which retail investors in the States managed to inflict on several heavily shorted stocks. It prompted reams of coverage because of the damage John Doe, aka Joe Bloggs, had managed to inflict on short-selling hedge funds, and the significant regulatory issues also raised by this episode. What concerns us here, though, more is just the implications all this has for the market outlook. Well, the sight of retail investors piling into particular stocks and driving prices up to levels bearing no resemblance to the fundamentals is, clearly classic bubble behavior and brings back bad memories of the tech bubble 20 years ago. Other areas of the US market have also recently shown signs of excess, with a surge in IPOs, that's initial public offerings, and also equity funds generally have seen a sharp rise in inflows in the last few months. So how worrying is this? Well, certainly if you're a fund manager specializing in short selling, this activity is going to look a whole lot more risky than it did a while ago. And you've already seen a couple of hedge funds hang up their boots. As for the army of Redditors, this is what users of the Reddit social media platform, which was used to coordinate these short squeezes, are called. As for the Redditors, there's really no reason to expect them to hang up their boots anytime soon. They're flush with their recent victories, and you've also got President Biden wanting to hand out to all US individuals another $1,400 on the top of the $600 stimulus check, which they've only just received. So their resources will only have increased. More generally, this is all a symptom of the liquidity which is sloshing around the markets, which is unlikely to be withdrawn anytime soon. There's still a mountain of cash on the sidelines, potentially available to drive markets higher. And importantly, central banks have no plan to start scaling back their quantitative easing or QE programs anytime soon. And this was confirmed last week with Fed Chair Powell very much emphasizing that he would tread very cautiously on this front, not least because the economy is still badly needing support. We certainly take some comfort from the macro outlook. Last week's data, has to be said, was fairly mixed, but as far as the market's concerned, this is very much old news. We had fourth quarter GDP numbers out for the US, Germany and France, and these confirmed that the Eurozone is seeing a double dip in activity, in contrast to the States, where growth has slowed sharply from the very sharp rebound you saw in the third quarter, but actually remains in positive territory. But much more important for the markets going forward is that a strong global economic recovery is still very much on the cards for later this year. And indeed, last week we saw the IMF revises up its forecast for global growth to a strong 5.5%. And this in turn should drive corporate earnings growth this year of as much as 30% or so. And in this respect, the current US reporting season has been pretty encouraging, with US companies beating expectations substantially. US earnings in the fourth quarter are now only forecast to fall around 1.5% compared with a year earlier, whereas back at the start of reporting a couple of weeks ago, the market was looking for a 10% decline. So big upward revisions there. Where does this all leave us? Well, in short, while we are far from complacent about the latest signs of bubble-like behaviour, we do believe this bull market has still some way to run. Okay, that's it for this week. Thank you for listening, and I'll be back again next week.